Hello, hi, welcome. It's an honor to be in front of you. My name is Amanda Wick. I am the founder of the Association for Women in Cryptocurrency, and I'm incredibly excited to be with four very brilliant minds in fintech who give me a ton of imposter syndrome and have been absolutely lovely preparing for this. Amber Huang is the managing director of Amber Group. Darius is the founder and chief investment officer of QCP Capital. Samar is the head of APAC for Talos, and Yusho is the co-founder and chief executive officer of Coinhako. So we only have 30 minutes. We want to jump right in and talk about the question that everybody's been asking for years in crypto, which is, when is institutional adoption happening and how can it happen faster? So let's start with the first part. Obviously, everybody's always looking for evidence of institutional adoption. Big announcement recently was BNY Mellon offering crypto custody services. Samar, as a tech platform provider, you have a very interesting neutral position, and I want to start with you. What did the BNY Mellon announcement mean for the industry, if anything, globally, or should we not think about it at all?
Yeah, thanks for the question, Amanda. It's pretty appropriate, the timing. So first of all, for those who don't know, let me very quickly explain what Talos does and why we have a unique insight. So we are a software provider that's used by institutions on the buy side and the sell side to trade crypto in an efficient way. And we provide these services to a lot of the hedge funds, a lot of the banks, custodians, and brokers. And so we see a lot of the flow and the activity of what's happening on the institutional side. It's pretty interesting. When an organization like Bank of New York Mellon, comes forward with a commercial offering like this, it is a very big deal. It is a watershed moment. They're going to be coming on later, and you'll hear from them directly. But in my view, when BlackRock and Goldman Sachs open bank accounts for their funds, they do it with Bank of New York Mellon. And so if they are having long-term visions of digital assets being a product that they need to provide due to their customer demand, I think that's a strong sign for the industry. So what we see personally at Talos is, on the buy side, there is a little less trading than there used to be, just because of the recent market downturn. But on the sell side, we're seeing a massive intake of customers who are signing up onto our platform, because I think that their long-term views on the potential of digital assets is undiminished. And so they're using this downtime as an opportunity to build and get their products up and running so that in the next growth spurt, they have their services ready for their customers. This is kind of the trend that we are seeing on the institutional side.
Now, that's super helpful. Annabelle, I want to turn to you because you have a ridiculously impressive geographical background starting in Wall Street and then your passion for decentralized finance. Given your really broad global experience, can you tell us, are there differences in institutional adoption geographically? Are we seeing any differences east versus west?
Thank you, Amanda, for the very kind introduction. I think actually all of us probably come from a mix of traditional finance and now moving into decentralized finance or crypto finance space. And I think over the years, actually for those of you who don't know Amber, we were founded 5 years ago in Hong Kong, recently moved to Singapore. So I would say we have a very strong roots and ties in Asia. But because crypto is such a global asset class, that our client base is actually quite global, and it's quite interesting to see over the years how the client base changes, and I guess how different sort of geographical differences in terms of client behaviors. I would say a lot of institutional adoption actually is still driven by the Western financial institutions. A lot of the banks, right? I think the BNY Mellon, of the likes, Delhi, the likes, still driven by at least their US side. In terms of a lot of the hedge funds, still a lot of the US names, or I guess Europe-based names that we're trading with actively at the moment. But here in Asia, it's actually an incredible scene of family office, ultra high net worth individuals, as well as a retail base that we are working with. So in terms of market structure, it's actually interesting as well to see sort of the flows, which I think we can all touch upon later, about maybe the retail or the individual side in Asia. It's still very yield driven, searching at least. So we see a lot of them participating in structured products or selling vol to monetize their market view and earn enhanced yield, versus I think in the Western market is still pretty much still flow driven, so more kind of proper flow driven. So it's interesting to see that dynamic, but I think now that Singapore has established itself as the Asia hub for crypto, not globally, then we see actually a lot of conversion into the East and West as well.
So you said something in there that I kind of want to pick out. You mentioned retail, and Yusho, I'm going to jump to you because given that you are the co-founder and CEO of a huge Southeast Asian cryptocurrency exchange, you are kind of boots on the ground for seeing the differences between retail and institutional adoption. What trends are you seeing in that area?
Yeah, I think just for context, for everyone's sake, so Coinhako is a cryptocurrency exchange. We're licensed in Singapore. We've been operating since 2014. We are primarily a retail-focused platform, but more recently this year, we have started to roll out the institutional arm to serve the more sophisticated clientele with a broader depth of products. So yeah, I think some of the trends we are looking at, obviously, institutional interest is very strong. It's an all-time high this year. But I think when we talk about institutional adoption, I think that's still a question mark to me. So where I try to pick out these data points is, I think we take a step back. Asia in general, we are more conforming, like what Annabelle said. A lot of the interest or the action is happening in the States, whereas across most sectors, Asia is about 3 years behind. So when we started the business early in 2014, it took us about 3 years to get the business up and running and even get VCs interested. So I think similarly, I think for institutional adoption in crypto, we can take the same approach. Reason being, for DBS, for example, they launched an exchange, but the whole process started as early as 2018 or probably 2019, right? So I think the next wave of institutional adoption will come because start of this year we have seen, or at least when I speak to whether it's recruiters or professional services, I try to get some sense of what's happening under the water. And many traditional financial institutions are looking at hiring digital asset teams. So what this means is, over the next 2 to 3 years, we'll probably see some results, and this should drive the next wave of institutional.
And let me just pick on that, because Samar, you've always, I think, taken the position that that's also a sign of institutional adoption. Institutions would not be hiring all these teams if they didn't think there was something there.
Exactly. I mean, I just wanted to add, Bank of New York Mellon is great news, but there's so many other banks and well-regarded institutions that are dedicating resources publicly to setting up digital asset teams, to hiring blockchain engineers, to building revenue lines and services around this exciting new asset class. And so they wouldn't be doing that if they weren't serious or they weren't getting their end customer demand for these services. And so Bank of New York's one great example, but we've got so many other banks who have already taken the lead. DBS is one of them, Nomura, Standard Chartered, they've all done great work in being pioneers. And we just feel that more and more are gonna start appearing and making announcements, and that's good for the industry.
And you said something in there that I think is also really important, that it's the digital assets, that it goes beyond crypto. And we tend to think of institutional adoption with crypto, but it varies among financial products. And touching on what Annabelle said, I know a lot of you have deep backgrounds in finance and capital markets. Darius, I want to turn to you. With your extremely deep background in capital markets, what do you think, is there a difference in terms of institutional adoption in capital markets or derivatives, or do you see anything, trends there?
Yeah, maybe before I start, just to introduce QCB Capital, we are a crypto trading firm. We provide institutional trading strategies and solutions for our clients. So, we are very deep in the capital markets and especially derivatives. So happy to shed some light on this question. I think just to take one step back, right, the capital markets use case for crypto was probably one of the earlier use cases, right? I mean, it's always been, from the start of crypto, there's always been enterprise blockchain, there's been tokenization, but trading crypto and trading tokens has always been a very big use case that has probably has the widest use case. And in that respect, I think the institutional adoption was a lot earlier than what people think. I think to begin with, if you look at 2019, was it, when CME had already listed Bitcoin as a traded future. So I think for the institutional trading side of things, the adoption has always been a lot easier in the sense that they just see it as a new asset class, a frontier asset class that is that's going to be part of the macro markets, traded alongside stocks, bonds, commodities. And I think this year, in spite of the big downturn and a lot of the the sort of credit crisis in crypto, if you can call it that, we have seen that being taken to a much further step, right? Because I think this is one year where, in a bear market, we see that the market structures are fine, liquidity has been fine. I think in previous bear markets, there was always this existential question about whether crypto would still be alive. I think this bear market, even though it was quite a big one, there wasn't that question. So credit imploded, but spot trading, derivative settlement, that's all good. And with that in place, I think institutional adoption in the trading and derivative space has taken a further step, right? So again, these are guys from traditional finance, including banks, hedge funds, family offices. All they see crypto as a frontier asset class, emerging asset class with additional inefficiencies that can be arbitraged or where they can extract alpha from. And I think this year has been the biggest one for us. I mean, we started doing options in 2018, but this year we started seeing guys that I used to trade with in my previous life, right? Big hedge fund names. I mean, just to give some color, I think in August, the month of August, right, a traditional hedge fund name was responsible for about a third of the Ether options volume being traded in the market. And that's very extremely significant, right? These are the same people that you face trading FX options with. Now they're trading crypto options. And to them, it's the same market structure. Some slight differences here and there. You have to deal with idiosyncrasies like ETH fork, for example. It's not a super dividend. It's something new. But these idiosyncrasies also create new alpha opportunities. And I think this is the new frontier for them, right? They see it as this very new asset class where they can make money from, and it's become very attractive. So we've seen that very big this year, and I think we continue to see that in a very big way. So we've been having more conversations with banks as well who have already started trading on CME, and they're going to sort of get into the OTC market, do bilateral trading. So I think that's probably going to be the easiest low-lying fruit adoption for institutions is the derivatives market, right? They don't have to deal with spot. All they have to deal with is settlement and trading of derivatives. And I think the momentum picks up from here.
So I want to ask a slightly spicier question, which is BNY Mellon commissioned a study to look at the interests of institutional investors. They I think surveyed more than like 270 of them. And one of the really interesting key findings was that Singapore and Hong Kong lead globally in terms of current investing in and exploring tokenized assets. I'm going to start with Samar, because I know you all have feelings about this. But do you think this indicates that other assets will migrate onto digital rails?
I mean, first of all, talking about Singapore and Hong Kong in general, I'm not surprised when I hear that the data is saying that a lot of stuff is coming from here. Obviously, this region has been pioneering in the digital asset space on many fronts, right? Whether it's the early crypto funds, the capital, the derivatives markets. So for APAC in general, I'm not surprised to see that the data actually points in that direction. But speaking about tokenized assets, yes, it's definitely a topic that we can probably debate, and we may have differences. So I, for one, sit in the camp that we believe that other types of asset classes will migrate onto digital asset rails. And I can explain why I think that, or I believe that. So everyone knows academically why it's exciting, right? You have this idea of creating liquidity in previously illiquid assets, being able to reduce operational overhead of servicing certain types of instruments like bonds by using smart contracts to automate coupon payments and things like that. And even this idea of being able to bring instant settlement to many types of markets. Those are all powerful ideas, and fractionalization, so that you don't need a minimum ticket size of 200K to buy in on, invest in the power station down the road, right? So these are the academic reasons. But for me, it's become much more real when we are demonstrating, for example, how Talos works for digital assets. So when we demonstrate our platform to a particular client, let's say a bank, people are able to see how we are able to do things with this asset class that we weren't able to do in capital markets. And that's the inspiring part, because you'll hear banks at the end of our pitch say, wow, that looks really great. Could you build this for bonds as well? And for us, that's a really good sign. It's a data point for us. And an example of what you can do, for example, that you couldn't do in traditional capital markets is, in one screen, right, you can see all your positions all over the world, right, at all different custodians, which again is already hard to do in traditional markets because of that spider web of different entities that don't talk to each other in real time. You're able to settle in real time. That's a very powerful thing. Imagine you're a trader and you're starting to hit against your credit limit during the day. You can literally press a button to settle, and that settle instruction happens on chain, and so it takes a couple of minutes, and your credit gets unlocked back to its full capacity, and you can keep trading. Those are powerful things that you couldn't do in traditional capital markets, and that's where the juice is, and that's why we believe when people get comfortable with this asset class and the new market participants, there will be traditional assets that will kind of start to migrate onto these rails. The last point I'll make is that I do concede that we are not there yet. Right now, the digital asset that is in abundance is crypto, and there's a lot of problems to solve in crypto. But over time, if other asset classes do succeed in building that value chain, because right now you need an issuer, you need a secondary market, you need a bunch of traders and investors who are up for it, for buying a product in this new format, and all the various investment banks need to figure out what is their role in this new world. So once those things are solved, right now they're happening in isolated experiments. I think that we could see a future where people will trade Talos for crypto, but also for other types of digital assets as well.
I saw you sneak in that caveat at the end, which now when I go to Yusho, now that he snuck in that caveat, do you agree or disagree? How do you feel about tokenization of assets?
Yeah, so I think tokenization in general, I think it's a beautiful concept, right? It has the potential to unlock trillions of dollars of illiquid assets. The concept is alluring, but I think as operator, I think a lot about token custody, liquidity, settlement. I think more importantly, regulatory and compliance, right? In an ideal situation, yes, you want to have global settlement, immediate settlement, but in reality, because the underlying is a security, the amount of regulatory approval required, it's jurisdiction-based, for example. So let's say if I have an STO platform in Singapore, it doesn't mean someone in the US is able to trade on it on day one, right? Because you have to get through all these regulatory hurdles, and just because of that, I'm not a strong believer.
Darius, Annabelle, do you want to be the tiebreaker?
Yeah, I mean, I feel there's sort of a little bit of a middle ground here, right? Because, like what Samar was explaining, that if you had real-time settlements, I mean, give a real example, right? If we had real-time settlements for trading positions on stocks, for example, we might not have seen that GameStop problem where the market was shorter than the amount of GameStop stocks available, because there won't be a contra issue. Things will be settled in real time. But that doesn't necessarily require the tokenization of the asset. It just requires, it's sort of a more enterprise blockchain approach where settlement of the positions are done immediately on the chain, I mean, by atomic swaps or whatever, right? So I'm probably leaning a bit more to the usual camp where you don't necessarily need to tokenize assets. And over the past few years, I think we've all seen a lot of projects talk about tokenizing real estate. And in the end, I think, that's good to have. But in the end, the crypto capital market itself, I think that's a fundamental sort of use case and adoption already. And that becomes the layer. And wherever the base layer and whatever enterprise adoption you have, it could be for, could be for health apps or GameFi or NFTs. I think that all sort of trickles down into the crypto capital market. Then that becomes the main use case. So tokenization of assets, like I said, 50-50, good to have. We haven't seen much adoption there. But I think the underlying technology and the underlying capital market is the part that we see the most value in.
Well, that wasn't much of a tiebreaker. Please tell me that you're going to actually break the tie, Annabelle.
I think I am going to because,
All right.
because before I actually spent basically all of 2018 looking into STOs, and I think there were two major problems. One is that there is no incentives for actual AAA or high quality assets to explore a route of securitization through token format. And that's also a result of, I guess, lack of regulatory clarity or the need to be such like fragmented capital market structures. And it's really difficult to solve that. We haven't solved that in traditional finance. I'm not sure if, I guess, decentralized finance format would solve that. And second of all, I think it's also sort of the idea that somehow it's STO so that it should be more valuable or better than it is. I think that's maybe a misnomer. At least back in 2018, I think that the space has evolved, but I think we're still some ways away from actually having both investor side and actual underlying assets, so supply and demand side, to actually have the need to do that. And what I'm personally more excited about, and I guess at Amber, what we're more excited about is new assets, new digital assets being created on chain. And that doesn't need to be real world assets. It could be through GameFi or maybe your own digital identity or any data set that can be created on chain. And that really using the blockchain underlying so that there's a need for financial intermediaries like Amber and the rest of us to actually service this market.
So just to be clear, that's how you break a tie, okay? So I want to ask a question of all of you because we've talked about how a lot of the barriers to institutional adoption aren't there before. Darius, Samar, you've mentioned in the past that things like liquidity have been improved. We've got AML that we can and the industry is doing. So I just want to ask each of you, what are the barriers that are left? Like, what do you think remains? Like, what's the hindrance to greater institutional adoption? Let's start, Yusho, we'll start with you down at the end and we'll just come on in.
I think they just have to change the rules internally, right? So if you look back a couple of years, VCs could not invest in crypto. But today, a lot of the VCs have already changed their mandate or recreate structures so that they can invest in token projects directly. And I think down the road, it's going to be the same for high frequency trading firms also did that. And down the road, institutions will do the same as well.
Samar?
Okay, so first of all, you touched on some of the original reasons why it was difficult for institutions to come in, right? 5 years ago, if a big institution says, okay, crypto looks interesting, let me come in, they had massive concerns about, is this ecosystem able to support the kind of volume that I need? So first of all, how do I not get hacked? And how do I move assets on this new method of blockchain instead of the SWIFT network? That's been solved by awesome companies that have solved the custody tech stack, right? And connectivity to blockchains and those kinds of infrastructure companies. The other hurdle was around AML. There are companies that are providing that and giving much more clarity than you could even get in cash, right? And government agencies are using these companies. Another area of traditional obstruction was in the regulatory side. Companies didn't know whether they could even offer services or engage with this asset class. But I think that's been solved because in various jurisdictions, the regulators have upskilled and they are legislating and giving a regulatory pathway for these firms. So a lot of these things are solved, and we are solving the piece around trading. How do you connect to the markets, face the markets, and trade them in a professional way? I think for me, if you were to ask me what's left, there are still a couple of pieces where the ecosystem needs to grow up. I think we've seen with this last crypto sort of market downturn, there was a little bit of irresponsible behavior around credit risk, systemic risk, and just in general portfolio risk, like single portfolio or too much assets weighted to one asset class. And so I think there are some companies out there already hard at work trying to solve that. So that risk management piece is an area that I would give you as an example. And then there are a whole bunch of ancillary services around tax and fund accounting, upstream and downstream, that still are being worked on, but once those are ironclad and you've got this entire value chain at institutional grade solved with multiple providers to choose from, suddenly the institutional investors, they're not going to have an excuse. It's going to be based on their internal management decision.
Yeah, maybe let me give a bit of a granular answer in two things. So, what's blocking? If you look at the crypto credit market, which is the most interesting topic this year, right? The way it grew in size, there was pseudo institutional adoption, right? It's a easily a multi-billion-dollar market, right? That function on credit ratings from Twitter and just sort of bootstrapped collateralized loans and uncollateralized loans flying around. But the size was very institutional, very, very institutional. And that imploded because of the lack of, I guess, institutional participation. No proper credit ratings, no regulations in place and whatnot. So I think one answer to that is you might need a bit more institutional participation, like from the banks to get into the space, be part of the credit market for that to grow. So in a sort of related note, if you look at the more trading space, derivative space, I think we are already starting to see some of these pieces in place. For us, we trade a lot of derivatives via ISDA, bilaterally, which we see in FX markets as well. I think one missing piece there is, a sizable or scalable prime solution, to alleviate credit risk and to encourage more scalable settlement between especially when you're trading products that are very leveraged. So I think we're already starting to see that come to play, but I think that there can be more done in that space.
Annabelle?
Well, I think the three gentlemen here has touched on all the points. I would just add that I think, I do think from at least what we've seen so far, a lot of the bottlenecks are actually still around, I think, regulatory framework. And I think the understanding in general of the institutions towards the space. We'll speak to institutions, and maybe right now we're servicing hedge funds or family office because essentially their mandate is a lot easier, right? It's a lot more flexible. If you're speaking to pension funds, they'll require essentially a checkbox, a checklist of things. And if you go into each of them, then you realize that this industry is not exactly there yet. It's not ready. If you ask any of the market makers for audited financials, right, then that takes time. And if you ask for custodians to adopt the financial rails on off-ramp, so it all comes down to little pieces that I think all of us are solving. And then it's great that I think a lot of us probably started off doing very similar things, but now things are starting to specialize in different, in solving specific areas, and now we end up to be partners with each other. And then I think eventually then we'll be able to build a more comprehensive or fully fledged out market infrastructure for them.
So we only have a couple minutes left, and I'll end with a completely surprise question that none of you know. The question, where's the institutional adoption? Does it matter? If the market's doing insanely, if it's $1 trillion crypto market, right? And yes, we're in a crypto winter, but people, depending on who you ask, think we're coming out of it. Does it matter if institutional adoption doesn't pick up, if it's the kind of slowly increasing trickle that it's been? And if it matters, why?
Maybe I'll start this. Well, it matters for me. Because I think Vitalik recently, he mentioned in a Decrypt article that he would rather not have institutional participation in Ether, which I vehemently disagree. Yeah. Because to create a scalable market that is very liquid, that is with scalable participation, and for prices to be more efficient, I think you need institutional adoption. You need institutional participation, and I think it's quite important in building a mature market. So I think the capital market side of things cannot be ignored. And if you see that as a use case, then institutions are very important in that play.
That's a great answer. Anyone want to follow up or finish?
I mean, so our whole thesis is that institutions are going to come in. We are set up to serve only institutions, B2B institutional grade software. And we all agree that in order to make this asset class and ecosystem grow, mature, stabilize, you need the institutional money to come in. And we're proving to them time and time again that we are working hard to professionalize this market. That's what I would say.
So I want to thank all of you, Yusho, Samar, Darius, Annabelle. From our prep session, I knew you guys were rock stars. It was an honor to moderate. I know you guys can see these are experts in their field. Thank you so much for being here, and we really appreciate your attention.